Hi, good morning. Thanks to all of you for speaking here. My name is Peter Somerville, and I work at Street Shares, which is one of these peer-to-peer lenders, marketplace lenders focused on small business. And agree with kind of the remarks that a lot of you guys are saying, where what our customers at Street Shares are telling us is that traditional banks are getting out of the business of making loans to small businesses, loans of less than, say, $200,000. And so for us, the exception to that, I guess, would be loans guaranteed by the SBA. But the process to apply for a loan of those on average, again, takes up to 6 months just to go through that application process. And so for Street Shares, we see a big opportunity. What I would, just to make a comment, a lot of the limiting factor that we see working with our customers is just kind of the education, where the dentist is a tooth expert. He's not necessarily a small business finance expert. And so for us, a lot of the work that we're doing is just educating them about what's the difference between a loan and a cash advance, something like that. So thanks again.
Thanks.
I'll just chime in. I was just at a World Bank conference on development in Mexico City yesterday, and I was taken by the perspective that a lot of the people interested in development more broadly. So in parts of the world where there is a whole lot less finance and a whole lot less development than we have here. And one of the things that I didn't appreciate was this financial literacy side of things, that the people that want loans don't even know how to try to go to get one. So it's not necessarily that the constraint is on the lending or lender side, but literally on how do you fill out the right application, and do you have any paperwork to document what you've been doing. Well, so that's an important perspective, I think.
And to sort of piggyback off that, I mean, some of the research we showed is that a lot of businesses or business owners don't understand some of the newer innovations, and that's one of the reasons they cite for, well, I wouldn't use it. So to the extent that new innovations develop, or to the extent that policymakers and regulators need to change the rules to enable new innovations, one thing they need to bear in mind is that it has to be understandable for a business owner, that you could create something interesting and exotic and things that MBAs can look at and be like, wow, that's really cool. But if people don't understand what it does and what it means and what am I signing up for here, they're much less likely to use it.
Yep. Anyone else? No, anyone else? Next, I guess.
Hi, Michael Kirsch, independent researcher. So on the theme of credit versus equity financing, a few things that the panel discussed really brought up some interesting questions to my mind. James Brown, you were mentioning how innovation is not readily financed by credit because of the increased risk. And generally, you guys talked about credit versus equity financing. Three things. One, what changes to the banking system need to be made specifically so that it's profitable for banks to lend to small business? Two, risk is not a static entity, a quantity factor. During periods of economic growth and stability, obviously there's less risk to lend for things like innovation. So is it the case that there's more credit financing and less equity financing during economic growth? And a related point is number three, derivatives, some of the risky derivatives. If changes could be made to the banking system to allow banks to profitably lend, as has been done in the past, to farmers and some of the things you guys mentioned, what changes to the banking system would allow more credit financing to take up the place of some of the more risky sides of the derivatives market?
Wow. That's a great question, and I'm not going to do a good job answering all of it. So let me say a couple things. One is that on average, most risky innovative activity is financed with equity, or in the aggregate, there's more equity financing of innovation. This doesn't mean credit is never used. It doesn't mean you can never get a loan to do innovative stuff. It's just that at the margin, the source of financing is probably going to be equity for the really risky and innovative stuff. Now, what could change? But I think this is fundamentally a characteristic of the debt contract. And the debt contract is bounded on the upside, meaning the best you can hope for is you get paid back. So short of some kind of hybrid security or changing the nature of the paybacks so that the creditor participates in the upside, participates whenever you have Google-like returns. It's not clear to me that credit would ever be the preferred or first source of financing for innovation. But I think you're right on the money with respect to changes in the nature of the risks over the business cycle, right? And so I don't know if anybody's checked this out, but it wouldn't surprise me at all if you don't see more credit flowing to riskier enterprises during economic booms for precisely the reasons that you suggest.
Let me just chime in on derivatives just for a second. Derivatives, by their construction, are a zero-sum game. And so when you say risky derivatives, that means you're on the wrong side, okay? Because if you've lost, and risk actually works both ways. It works for you and against you. And so derivatives exist to shift risk from parties who have it, who don't want it. And so I didn't quite understand your question on what to do about risky derivatives or how you phrased it.
Just that in the 19th century, a lot of the banks were able to extend, to roll over a loan for farmers.
Yes.
Now the farm financing is done through the derivatives market. So the question is could the banks be brought back into some of the roles that the derivatives market now allows, things like the agricultural financing?
Well, I can speak to my own experience as a derivatives broker, that when we had farmers who were trying to expand their herds, the bankers would lend to the guys that would shift their risk of cattle futures prices. Using the contracts, it would reduce the risk of the operation, and the bank would step in and generate and help loans. So we would form a partnership that way. I'm for that. So.
Anyone else? No? Okay, next.
Thank you for your presentation and insight. My name is Courtney Vaughn. I'm an independent consultant, and I've worked anywhere from syndication finance to sovereign debt, small business, etc., Wall Street, World Bank type deals. So my question is, and it's more in terms of your observation, okay? Given that we have gone through, the major financial crisis, and it has impacted many countries, and I'm putting this now in the context just of the United States, do you see any changes in the banking sector, for example, as it relates to collaborating with innovative companies such as some of the payment platforms like PayPal, who is now lending to whomever is using their system, right? They're using different evaluation criteria that is not as restrictive as banking institutions. That's one. And in terms of evaluation, when you're looking at the emerging entrepreneurial class and the way valuation is done for the accredited investors sector, do you believe that some of the methodology that has been used, by way, say, present value, et cetera, that those things are like too inflated, right, and could affect the small entrepreneur coming into, say they never get private equity as the next, VC capital as part of the next step of funding, right, but to be able to get into the formal banking system for loans. Do you believe those valuation needs to be, to be reconsidered? And I'm asking that more from an academic perspective.
Well, I'll take a crack.
Perhaps.
I'll take a crack at the first one, which is the partnering of banks with technological innovators. And yet we're seeing a lot of that. We're seeing that there is a real shift, and there has. When the financial technology innovators first came out, it was all, we're going to kill the banks. We're going to kill the banks. The banks are dead. And now it's hey, look, we're partnering with this bank. Isn't this great that we're partnering with this bank? And it is, in many respects, it is great, right? Because banks, for a host of different reasons, regulatory, cultural, the fact that they tend to be very large, ossified institutions, don't necessarily do innovation well. Young, hungry startups, innovation is what they have. If you're not an innovative, young, hungry startup in Silicon Valley, what are you doing there? So there is a way there where you may see basically these financial technology companies coming on board and sitting as sort of a service layer on top of the bank's capital. There are potential sort of regulatory questions that kind of cut both ways, right? Is it, are these innovative companies just sort of enjoying a regulatory arbitrage? Are the banks sort of laundering their regulatory arbitrage? So, hey, you wouldn't let us do this on our own, but we'll just invest in a company that's doing it anyway, and the funds will flow to us. And I think it's a fair question, going back to the earlier comments, that if regulation is preventing people from doing what they want to do in terms of funding small businesses, and you're having to come up with these new arrangements and these new systems to do it, maybe that speaks to a problem. And I mean, to the extent that you're having to jump through new hoops, technology can help mitigate jumping through hoops up to a point. But to the extent that you're having to jump through hoops, maybe you're losing out on value there. Maybe you're losing out on societal value there. So, that's not necessarily a direct answer to your question, but it's the best I got.
On valuation, is there?
On valuation?
Yes, valuation is close.
That's a great question, because the hunt is always on for better valuation techniques and models. And the problem with valuation is we're always looking forward in time. And so we have to make estimates on cash flows that are uncertain. And so, if you're better at valuing than somebody else, that's a profit-making opportunity for you. And so we like to think that in general the market gets it right in terms of prices, not because of the information we all share and interact in a competitive market. But in the U.S., we're lucky that we have generally accepted accounting principles that people adhere to largely, WorldCom notwithstanding. But but largely, I mean, we can trust the numbers. And that's that's important. That's an important part of the financial system. So for valuation models, if you have good ideas on valuation models, you'll do well.
Okay, thank you.
Next question.
In light of recent claims of a bubble within the tech industry or the tech startup industry more specifically, especially with the growth of the number of startups with tech startups with more than $1 million in seed funding, do you see the growth in that particular sector as a result of asymmetries in the regulatory burdens associated with tech industries versus other industries? Or do you even see a bubble in the tech industry at all? And what do you see as a solution for that, if that is the case? And if those regulatory asymmetries are causing funding to disproportionately flow to the tech industry, what could be done within the regulatory burdens of the financial market to address that distortion?
So I guess somewhat piggyback on my earlier comment where, and let me say first that I think it's a very real question, particularly in the financial technology space, how much of regulatory asymmetry there is, right? If you go talk to banks, they say, oh yeah, regulatory arbitrage, these guys play by a totally different set of rules. You talk to the innovators and they say, no, we don't. We have all this regulation too. We've just built a better mousetrap. I don't know who's right there. I guess the question is if financial technology startups have come up with a way to serve people's needs that banks cannot or will not do because regulation makes it impossible or unprofitable, then that's not necessarily a bubble. That's a good value add solution. I don't know. I mean, the problem is, of course, I don't know, because part of the problem is that the regulators have not come in and said, yes, everything you're doing is absolutely great and wonderful and you're fine. They haven't come in with handcuffs and guns either. So there is in a lot of cases, there is an open question as to whether they've figured out a way to they figured out a way to structure something so that it's regulatory compliant and more efficient. Or no, there actually is some sort of regulatory deficiency, they just haven't been called on it yet.
Also, the question becomes how much of it, trying to disentangle how much of this is market-driven, right? The innovation that we want, and how much of it is, a result of bad regulation, over-regulation, shifting around resource, and so on. If you've got the answer to that, great. If you've got the answer that we're actually in a bubble, I guess we should all be shorting something right now.
I was going to say, I have no idea how to tell when we are in a bubble. Even after the fact, sometimes it's hard to know when you're in a bubble. But just because a lot of capital is flowing to one sector, and even if a lot of those companies that got capital end up failing, doesn't mean it was a bubble. Right? I mean, I think this is a vibrant and healthy financial system if you're taking some chances on companies with, a high probability of failure, but a really big payoff if it works out.
And that's part of the wonderful of the market system. You're talking about getting prices right. Well, we often don't get prices right, but the fact is that markets correct, and that's the wonderful thing. Getting back to real basic stuff, I always tell my students, what's the difference between government and private markets? Private markets, they get something wrong, they adjust, they reallocate. What does government do? They get more money, they get rewarded for failure. So that's the fundamental difference, right?
Thank you.
Do we have time for one? Okay, so I think this will be the last question.
I wanted to ask your thoughts on a point that Representative Garrett made in the difference between the way debt financing is predominantly done in the U.S. versus Europe. So in the U.S., if you want debt, you issue it. You're more likely to issue bonds on the open market, whereas in Europe, you go to the bank. Now, there's an argument that this is due to, or this is because of restrictive banking regulations in the U.S. or the history of it. In particular, the restrictions on branch banking and interstate banking that characterized U.S. banking history for a long time. And the argument is that capital markets developed so deeply and with such liquidity precisely because the banks weren't in a position to lend on such a scale as they were in Europe. So the straightforward implication of this would be that bond issue on the open market is kind of a second best to bank finance. But maybe that's not the case. So my question is, number one, could you talk about some of the practical differences for economic growth or performance between the two different ways of doing things? Number two, do you think it's a fortuitous development that the U.S. developed this way? And yeah, that's it.
I could chime in on that.
Sure.
You're exactly right to point to these differences in the way financial systems have developed. We clearly have a more market-based system. Much of Europe has more of a bank-based system. I think, at least in terms of risk capital and funding risky activities, we're at a huge advantage to having arm's-length financing that's relatively freely available compared to systems that's more relationship-based. More monitored finance, more monitored kind of financing, lending from a specific bank often means watching to make sure you don't do anything too risky. So I think one consequence of what in some sense were historical accidents, one consequence is that market-based systems have been the risky, innovative leaders relative to bank-based systems because of arm's length financing, including bond issues. So not just debt, but also equity.
To the question about whether or not it's a second best system, the first answer is I don't know. But the second answer is that answer might change over time due to things like technology. Yeah. So if you are able to access a bond market easily, and if bond buyers are able to access information about you easily, and if technology allows that to scale down to smaller and smaller businesses, which is of course my particular interest, that might actually make that better than a banking option, whereas absent that communication ability, the answer might switch, right? There may be a value to having this big central party. So it's hard to tell whether or not it's the first best or second best option, and the answer, I think, is changing as technology develops and as things like crowdfunding broadly defined may develop, where you might be, smaller businesses may be able to access people who are willing to take a little bit of risk at, a reward, where a bank might not be willing to bite down on that whole big risk pot.
And does your regulatory system allow for all those innovations to take place, which is what the Congressman was talking about earlier today, that, Europe, not so much. Many argue, and I agree with the Congressman, that we're heading more and more down that European path. So the key is to have a system that allows for all these wonderful innovations to take place and capitalize on them.
And we may enjoy the fruits of that because we have an analogy we can point to, and we're trying to point to saying, oh yeah, it's kind of like the thing we do at the big end, but scale it down. Technology allows us to scale it down now. And if you don't have that background, if you don't have that analogy you can point to, it might be harder to get people to wrap their minds around it.
Please join me in thanking each of our panelists.